James, how did the Harmony range fare last month?
Well, the month of February represented something of what we would have thought as an overdue pause in markets, really. They've run up pretty aggressively since the middle of last year, and as you know, in a number of these recent videos we've been suggesting that perhaps a pause is overdue. February brought with it issues such as an Italian election, UK debt downgrade, and so, although these challenges came and perhaps knocked the market off its stride a little bit, it's quite interesting to note that even in a month such as February, the equity markets were still positive come the end of the month. In light of that backdrop, the Harmony funds all provided positive absolute returns again, and for the majority of the range, in fact, it's the 8th consecutive month of a positive gain. So, it's again a pleasing month, some decent returns in the range, and positive absolute returns across the board.
Can we isolate some of the key drivers of performance last month?
Yeah, sure. In January, we referred to taking our equity overweight back to neutral. Again, we just thought, although not bad value, the equity market had got a bit ahead of itself and was due a pause. As a result of that, we weren't materially impacted either way by what was a pretty sort of muted equity return over the month. The more important, more impactful drivers really came from the fixed income allocation. We are heavily underweight government bonds. We have been for well over a year, maybe 2 years now, on the basis that they were fundamentally overvalued. And in February, while they provided small positive returns, our allocation to the credit market outperformed those on the whole, again only by a small margin, but enough to help the absolute return profile of the funds over the month.
Yourself, Glyn, the team, did you elect to make any big changes last month?
No, the changes were quite small over the month of February. We stayed on neutral on the equity markets across the month. We maintained our property underweight, but complemented by the infrastructure securities overweight. We maintain an underweight position to government bonds, favouring taking positions in the credit market, high yield and investment grade credit, for example, as well as strategic bond mandates. Looking forwards, we are anxious that the main sort of valuation point off which credit is priced is the government fixed income market, and because that's expensive and the spreads on investment grade credit and on high yield, for example, are much narrower than they were 2 years ago, let's say, we feel that the valuation there, while not overvalued, is looking quite full now, and while we like the allocations to those markets, we think it's worth reducing the risk to them slightly. So one thing we are doing in investment grade and in the high yield space is really to reduce our duration, which is our interest rate sensitivity to that asset class. What is interesting, you can buy shorter tenor high yield securities at largely the same yield as you would get, or at least the yield spread over government bonds that you would get in the fuller part of the curve. So there's not a massive penalty to move into what is arguably a less volatile part of the high yield market, which is what we're doing presently. We also favour floating rate debt over high yield where we can, so we're increasing our exposure to floating rate loans at the moment, literally as I speak. That is a better valuation compared to the high yield market, and also the floating rate component will provide a degree of protection against inflation, because the floating rate is priced off LIBOR, and as inflation goes up, LIBOR will start to go up with it, and consequently the income from those assets will push up as well.
So some changes in the fixed income portion of the funds maybe. What else can investors expect looking forwards?
Well, I think we mentioned in the last video that January was an excellent month. We shouldn't expect that to continue particularly. And that 2013 was likely to look a positive year for equities, but with the occasional interruption as risk-off sentiment increases, and largely February was probably more of a quintessential 2013 month. Perhaps it was a positive period for equities overall, but far less of a sort of bombastic, linear style of market conditions, really. I think it's worth noting as well that in the last couple of months, a serious risk-on period over the last 6 months perhaps, these are conditions that really favour high beta, sort of higher risk equity managers, and while we aim to provide really a fund for all seasons in the Harmony range, so perhaps we're slipping down the peer groups a bit over the short term. We take the view though that consistent returns against peers over the short term equates to top quartile performance in the long run.
James, thank you very much.
Thanks, Richard.